The last 2 years have been a roller coaster ride for the Indian market thanks to COVID-19 pandemic. And if that wasn't enough, we now have a full-blown war raging in Eastern Europe that continues to dominate Indian markets as domestic equities slumped more than 2% and the rupee hit a lifetime low, reacting to the surge in crude oil prices. Stock markets have reacted sharply to the war between Russia and Ukraine. Both BSE Sensex and NSE Nifty ended in red on February 25, 2020, a day after Russia launched a full-scale attack on Ukraine. Volatility has intensified worldwide. Investors are panicking and taking money off the table. So amidst this uncertain situation, many investors are asking the question, should I redeem or sell my mutual fund investments now? Is it really the right time for the investors to change their investment strategy? Well, with that said, in today's video, we are going to discuss whether it is really the right time for the investors to stop their SIPs and withdraw funds. So do make sure that you watch this video till the end because we don't know whether the war between Russia and Ukraine is going to end anytime soon, but we do assure you that we will direct you to the right investment plan. So first of all, it is not just the tension between Ukraine and Russia worrying the market, but in fact, we also need to take into consideration other factors such as skyrocketing inflation, overheating crude oil prices, supply chain disruptions, the possibility of interest rate hikes, liquidity squeezing, and their serious ramifications on the economy that are all making markets jittery. Also, let me tell you that this is not the first time that the market has crashed so badly. We have several such instances of the past wherein we have seen markets so low. For instance, during the Asian debt crisis of 1997-98, the Sensex fell from 4,000s to 2,700s in a matter of months. But from there, the index surged to almost 5,900, which was more than double the low point. Then we also witnessed the 9/11 attacks in 2001. From its previous highs in the 5,900s, the Sensex fell to 2,600 level. But those who had invested during that tough period were rewarded handsomely as the great Indian bull run of 2003-2007 saw the Sensex past 21,000. Many of you might have first-hand experience with the 2008-2009 recession due to the global credit crisis. From the highs of 21,000 within a year, the Sensex fell to 8,000. But the rebound from there was an almost unidirectional upward journey to 40,000 by 2019. And finally, the ongoing pandemic spooked the markets, which fell 30 to 40% in just a month. The Sensex fell to 25,000 in just a few weeks' time. Once again, from there, it bounced back to touch 62,000 in the last few months. So from these instances, we clearly understand that despite the huge fall, wherein we saw market crashes are sudden and cause a lot of volatility in the short term, there is almost always a strong recovery that takes equity markets to a new lifetime highs. In the times of crisis, investors start having doubts about the future of the market and at the time act as if they do not know whether there will ever be any recovery. The markets have seen many wars, recessions, and geopolitical crises in the past, but they have always bounced back. This time too, it shouldn't be any different. When there is a lot of negative news going around and markets are behaving widely, there is often a tendency among investors to panic, overreact, and do something. But this is exactly what you should avoid. There is absolutely no need for you to overreact to the news headlines. If you study a bit of market history and what happens when the flow of bad news stops, you will see that the markets always rebound smartly from every crisis. Now, what you need to remember is that instead of reacting to the market behavior, you should rather focus on using this opportunity to buy more units. Winston Churchill had once said, "Never let a good crisis go to waste." That quote is indeed quite applicable to investing. So if you are investing for long-term goals, then just keep investing as usual. There is absolutely no need for you to make any kind of changes to your investment strategy. Also, in fact, the fall in equity markets provide a good opportunity to invest for lower levels. Now, although your equity investments might have got you worried, but then you need to remember that your systematic investment plan in mutual funds will help you to bring down your average purchase cost. Remember that the SIPs fetch more units when market prices are lower and lesser number of units when market prices are higher. This helps investors take advantage of market volatility, and by bringing down their average purchase cost, improves their investment returns in longer term. The other thing you need to remember is you need to avoid hasty decisions. It is not at all advisable to hastily liquidate the investment in a volatile market. Your decision may soon turn to regret once the market bounces back. More specifically, a short dip in the market should definitely not be a reason for you to sell it. There needs to be more compelling reasons for the liquidation, such as achieving an investment goal or avoiding any kind of specific risk that hurts you badly. For example, owning stocks in the company whose primary source of revenue is Russia. If at all you don't have any other compelling reasons, then holding your ground may make more sense. A recovery may soon follow. It would be best if you do not panic where you see your investments in red. Continue to invest in a manner your objective dictates. The other thing you need to remember is you need to check your financial goals. Your financial goals will guide you through the uncertain times. Your goals will help you to decide whether or not to stay invested or withdraw your funds. As of now, most of the investors' portfolios are down, and there is nothing to indicate that they will not go down further. But to reiterate yet again, history tells us these events have a short-term impact on the long-term trajectory of markets. So you would do really well if you remain focused on the long term and take advantage of the fall. For example, suppose you have invested in a 5-year SIP and after 3 years, say, something unexpected like this war happens. Then in that case, you still have 2 years to wait to let your investments grow or to recover from the fall. So do remember that you need to continue with your SIPs as regular. Also, if you have fresh surplus, then consider gradually investing it in equities. Also check your asset allocation and rebalance it if the fall in the market has reduced the equity proportion considerably. And lastly, you also need to remember that you think for long term. Now, although no one wants the war or the crisis to continue, but if it does and market remains down for longer time, then it is blessing in disguise for the long-term investors in the accumulating phase. So this was pretty much about whether the investors should choose to continue with their SIPs or not during the times of crisis. Also, if you're someone who's new to investments and you want to learn about investing in mutual funds, investing in stocks, or any other investment avenues, then we have a full-fledged course on these investment avenues available only on our Financial Freedom app that you can download easily from Play Store or App Store. Also, before going, do not forget to hit on the like button, subscribe to our channel for more such financial content, and do not forget to hit on the bell icon to get notified for our next video. Thank you for watching IndianMoney.com. Get wise, break free.